Well, greetings, everybody. This is Mark Robertson. This will be our April 2012 edition of Dashboard Diagnostics. I'm joined here by Lori Fredrickson from Vivio. And the club tonight, in fact, we have two clubs that have decided not to select the Witness Protection Program, so we'll actually be identifying them by name. Joined here by Stuart Weissman from the New Jersey club we'll be talking about first. And he's actually a member of the second club also, and you'll see the linkage as we get to it. And we just want to talk a little bit about that type of thing, perhaps even talk a little bit about the notion of model clubs throughout the country and that sort of thing. But first of all, welcome to everybody. I see a lot of familiar names, but I also see a fairly significant number of new names. So we'd like to extend an extra special welcome to those of you. We're excited that you're here, and we hope that you enjoy tonight's session. So with that, if you're ready, we'll go ahead and get underway. Let me get a couple things out of the way here. And since it was New Jersey, I hope you don't mind, Stuart, but I had to put in that photo. I thought it kind of, gave it the what's the show on HBO that was so popular a few years ago? Well, I guess it's still going.
The Sopranos.
The Sopranos. I thought there was a little Sopranos element there. I don't know if that's anywhere near your part of New Jersey or not, but I thought we might have some fun there.
It absolutely is, actually. Every setting for that show was pretty much within 5 to 10 miles of here. So.
Oh, fantastic.
Yep.
Very cool. All right, so again, if you're new, what we basically do, and we've been doing this now for, I believe, almost a little over 2 years, and what we do is we reach out there. We don't select them scientifically. We don't go out there looking for any particular story. We very often have an investment club come to us and say, why don't you take a look at our portfolio? And every single time we've done this over the last couple of years, we either find some type of a story to explore or perhaps an individual stock or something, but there's always lessons and there's always opportunities to learn from certain things that clubs experience. And we haven't been disappointed yet in a couple of years. I don't think you're going to be the least bit disappointed tonight. Let's go ahead and make the lawyers happy first. We will be talking about some real stocks. We'll be looking at real club portfolios. Keep in mind that anything that we talk about tonight, no investment recommendation is intended. One of the things we're known for at Manifest Investing is our willingness to operate in demonstration mode and basically illustrate and display the philosophies and the processes and methods of, frankly, the modern investment club movement, going back and basically leaning on the lessons of the last 60 or 70 years in the things that we do as long-term investors to try to be successful collectively. And we literally do care about everybody around us, achieving better results. Tonight's club, and again, like I said, they did not choose the Witness Protection Program. That is the name of their club, Mad Loot. They do operate out of New Jersey. I believe all of their members are from New Jersey. Now, Stuart, I didn't know how many people were in the club. If you could give us a little bit of background on how many people are in the club. And
sure. We have, well, we currently have 10 members. We established ourselves in 2004 and made our first purchase, which, funny, was actually a mistake, but sold it pretty quickly after when we redid our SSG, and we ended up making a little money off of it, so it was a funny way to start.
It's a good mistake.
We've had 20 members in total if you count our churn, but the average member right now has been with the club for about 4.5 years. And just give you advanced warning, we're probably going to be profiled in the Better Investing magazine as I was asked to fill out a questionnaire on behalf of the club. So some of this may sound like a repeat or will look like a repeat when you read it, hopefully next month.
Well, that's cool. They won't be using that picture, I'll bet. That is cool. Is it?
No, we actually took a pretty funny picture of the club. I'm not sure if they'll... Go ahead.
Well, I was just going to ask: is it all men, all women? What's the makeup of the club?
It's actually a mix. Right now, we only have one female, but we've had multiple females in and out over the years, and we hope we can make it more of a mix once again. It's certainly. We're not looking one way or the other, and anyone who's willing to put in the work and is interested in joining us is, of course, more than welcome to.
Cool. Well, she probably thinks it's a fair fight with the odds stacked in her favor there, but Now, is there a common thread, or what brings you guys together as a common thread running through the group, or anything you can share on that?
Yeah, sure. I mean, some of us, I guess it kind of branched out from friends of mine from college. I went to the that prestigious Ivy League known as Montclair State College in North Jersey, and so I met a few friends there. And the funny part of it is the group in which kind of steered the formation of the club. None of the others besides myself actually joined, but some other friends from there joined, and from there it became friends of other friends, and a few people that I met online in the New Jersey real estate blog are now in the club, and it's just grown from there.
Excellent.
And it's pretty young. I'd say what separates us or makes us a little different than most clubs is that my son's screaming because the Devils just scored a goal. So,
well, we can celebrate that too, right?
Yeah, we're big New Jersey Devils fans here.
Is it Game 7 tonight?
It's Game 6, but they are staving off elimination already, so they have to win this one to get a chance to win it down in Florida. But getting back to the club, it's really a lot of young people. Most of us are in our late 30s, early 40s, and usually when you see the profiles of most existing clubs, they tend to be made up of retirees, we find. So that part's kind of interesting.
That is cool.
Yeah. So it's fun, and we're very informal. It's just a very easygoing. I mean, at some points we probably have to go back and fix up our records a little bit to be more official, I think, as our purse grows larger and it becomes more of an issue. But yeah, it's very informal, very easygoing club.
Well, with that, that's kind of an excellent lead into we need to start with just simply saying congratulations. The rate of return, that is the rate of return compiled. They have been the Mad Loot Club uses the Bivio club accounting software, and you can go in and actually look at the performance benchmark report. That's where we took a look at it, and we find that the rate of return since that April 2005, that's probably the official time when they started tracking, is 10.1 versus the S&P 500 measured over that same time frame checks in at just 6.5%. Now those are annualized numbers per year. And so that's a relative return against since inception of plus 3.6 percentage points per year, and that's just awesome. That's awesome performance. We like to shoot for 5, but anytime you achieve a positive number there, you're doing something, basically outperforming the vast majority of people who ever try to do this. It's basically like shooting somewhere in the 70s as a golfer. That's the type of level of excellence we're talking about. And Lori actually noted tonight that the trailing 12-month relative return is 12.5%, probably bolstered, if I had to suspect, by a pretty good stake in Apple here over the last year or so. Well, here's the actual portfolio. You guys, everybody likes to
juice.
Go ahead.
Yeah,
Go
I was
ahead,
going to say Apple's definitely juicing our returns, but from about April of 2009 till now, we've really been on a streak that would make probably most hedge fund managers jealous, because up until that point, we actually did pretty poorly relative to the overall indexes. So something clicked in with our portfolio, and it's not just Apple. We have a lot of winners that you can't see here, because one thing our club does is we don't hesitate to sell. And we've sold a lot of winners along the way, and I think that's the secret to our at least recent success. Is early on we were definitely afraid to sell things, and now we are more likely to sell things rather than hold out another quarter to see if things change.
Right, and it's fair to say, there's a couple things I want to mention.
And it's working very well for us.
Yeah, and there are a couple things I want to mention in that regard, especially to the newer investment clubs out there. I would encourage, again, in that first 3 or 4 years of performance, not to get too hung up on the actual performance. I mean, it is good to keep track. That's just for clubs in general. Don't be worried too much about the performance. And again, don't be worried too much about selling, although as Stuart just mentioned, I do think you want to develop that process and that discipline fairly early on. We used to run into clubs that have been in existence 10, 15 years that had basically not sold a stock unless they've been forced to, and it's good to hear that you guys are willing to do that, because when Ken Kabul and I go around the country, we make the point that we do grant you permission to sell. There's no doubt about it. There are selling opportunities that's okay.
Mark, if you want to switch to my screen for a second, I just updated your request for positive relative returns graph, Stuart, and it's really phenomenal, and you can see exactly what you were just talking about on this.
Okay, hold on. Let me get you Lori here.
Well, I'm glad by being on this we get an update on that. It's one of our favorite things to look at.
Oh yeah, check this out.
Yeah, I've been a little behind. It's been tax season, but this is one of the more overwhelming ones that I've seen. And what you're looking at here, this yellow line is kind of the average of all the clubs that are participating, and the green line is Stuart's club. And you can see exactly what he was talking about. Here's the older. Look at this. This is just a phenomenal.
Yeah, and keep in mind that's rolling 12-month averages, looking at the relative return over 12 months. Yeah, yeah, that's that would. I know of several people on Wall Street that would be happy with that, Stuart.
I'm aware.
That's really impressive.
Yeah, so
and it's most of these are above plus 5%. Yeah.
Yep, and it's kicking up again as of.
Yeah.
So kudos.
I mean, certainly once do this tomorrow and you could add 7% to our Apple position, which is 26% of our portfolio again. So once again, it's going to juice
up. All right. You'd be knocking on wood over there now. I'm going to go ahead and switch back to me, guys.
Yeah.
Sure.
All right. Taking a look at the portfolio, you can see there's a couple things that we would pick up on. First of all, let's answer this question. How much is too much? At least give an opinion. As Stu just mentioned, that the price in after-hour trading for Apple was actually, I believe, somewhere around 610. I know it closed above 600 in after-hours trading, so it's headed for quite a boost first thing in the morning. You guys can enjoy your cup of coffee tomorrow morning. So how much is too much?
Maybe sell some off.
Yeah, I noticed that you guys actually had, and maybe you will get an opportunity to do that. Let's talk a little bit about that in a second. The other thing that we'd look at is the other end, just 2% down here for AmTrust Financial Services. And again, let's just kind of talk about position size here for a second. It's not something we've covered in the last several months here at Dashboard Diagnostics. And let's just kind of take a look at this. And again, with emphasis on the word guideline. Again, this is not a rule. It's not anything that's hard and fast, but it's just a way to kind of frame a mode of thinking. And again, the size of the positions that you're willing to target and hold, both from a maximum and a minimum standpoint, really are a function of the number of stocks in the portfolio. If you've got 20 stocks in the portfolio, you think about a position size differently than you do if you only have 8, okay? And in the case of Mad Loot, they're somewhere in this range right here. And what you see from the top end of this range to the bottom end of this range is basically double. The top half of these bars are 2 times the average position size. And again, anytime a position gets much bigger than that, if it were my portfolio, I would begin just to watch for, monitor for selling opportunities to do some trimming. And you can see that's coming in somewhere in that upper teens. Their Apple position is up here. So if it's mine, and again, this is also impacted by the amount of money that comes into the portfolio from the 10 contributing partners, and whether or not that will catch up over time. But just kind of keep that in mind. 2 times the average position size in this case is somewhere in the upper teens, and then on the low side, this is half of an average position size. So you really would want, most of your positions, the smallest stock in the portfolio probably ought to be somewhere around the 4% range. So you'd again, just as a guideline. How much is too much? How much is too little? Going back to the previous screen, basically AmTrust looks like a pretty good company. It's one that I have not paid much attention to. Very high quality, decent looking returns, and perhaps one that could be considered for some accumulation based on what.
And Mark, if I could interrupt.
Yeah, go for it.
The reason our portfolio is, our position in AmTrust is so small is it's our most recent purchase, and we tend to scale in to positions. So that explains why it's only at 2%. We don't usually leave positions at that size, but sometimes when we buy something, the price gets pretty close to the maybe zone between the buy and the maybe. And when that happens, we tend to purchase a smaller position knowing that hopefully the price will come down lower and we can purchase more, do a little dollar cost averaging. And if it shoots up from there, you know, it's fine. You know, it's still a position either way.
Absolutely. Well, that does explain it. Thank you.
Yep.
All right.
But, and, you know, as for Apple, we've sold pieces of Apple multiple times over the last few years. The problem is with its growth, it just keeps taking off on us, and as quickly as we all try to contribute and grow the rest of our holdings, because we haven't added to Apple in ages, it's really, you know, it's really something else.
Yeah, we did notice on your transaction report that you added pretty significantly back in 2008 and 2009, and that obviously that was at a pretty attractive price level.
Yep, it was, and you know, we had something similar with Netflix, where we purchased Netflix and it went up many times over, and we kept selling off our position to get it back under you know, 20%, and it just kept going. And you know, the PE, I think in that one got up to almost 90, and actually I got into a debate with the rest of the club, and you know, they voted to hold on to it, even though I was very against it at that point, and it became a pretty good lesson for the club once it you know, dropped all the way back down to almost near where we bought it years earlier. So
wow, good stuff.
Yeah, it's just one of those cases where you do have to sell off chunks of your flyers.
Absolutely. We certainly believe that too. All right. For those of you that may be new to Dashboard Diagnostics, here is the Mad Loot Club subjected to what we think of almost as a report card. We think the three most important design characteristics for any portfolio are the return forecast. That's the collective or weighted average return forecast of the entire portfolio. Mad Loot checks in at about 12.2. Again, that's just a number. You have to compare that versus the general stock market. That's what you see up here. 8% is basically the median or average stock out there. We track about 2,500 stocks to come up with that 8% calculated daily. And we basically want to aim for 5 to 10% above that. And that's what's depicted by this target zone over here. So in this case, Mad Loot's actually in pretty good shape, pretty close to the target zone. And if anything, we just want to look for opportunities perhaps to add to higher projected return stocks. And if anything, if you get an opportunity to sell off one that has a lower projected return, we'll be covering that in a minute. Quality, extremely important. The portfolio is very well balanced when it comes to high quality stocks. We just know that having something in that 75 give or take range is a portfolio that's probably going to stay out of really deep trouble during corrections, bear markets, and that kind of stuff. So again, the Mad Loot portfolio is in perfect condition there. Having enough slow-growing companies and fast-growing companies to come up with an average somewhere in the 11% range, give or take, is also something the club is doing quite well. Again, I'm just going to come out and say this is part of the reason that you're doing as well as you are. You're willing to invest in some of the smaller, more promising, faster-growing companies and basically balance them with some of the stalwarts or deeper blue-chip type companies. So that's part of one of the main contributors or contributing influences to success as a portfolio. The PE is pretty much normal, so is the yield. Financial strength basically checks out at about an A, and the earnings per share stability is also pretty good so most of the stock selection guides are going to look pretty good. Here's another look at the portfolio. Again, this is kind of the action point where we think about how would we take a look at this portfolio, and in this case we take the dashboard and we sort it by the return forecast, the projected annual return from highest to lowest. And this is just simply to identify the companies that perhaps are candidates for challenge, and there are actually two at the bottom that have elevated return forecast, depressed return forecasts because they have elevated prices. The prices on both of these have actually been zooming pretty good. We're going to take a closer look at both of them, and you can say even with all the stuff that's going on with Apple these days, it's still not one that's screaming sell or anything close to it, in our opinion, long term. If we get a few extra minutes, we might take a look at a presentation that I put together for some other people, where the bottom line is basically look for protective measures when it comes to Apple. There perhaps are some things you might want to think about in terms of protecting yourself against what could be a fairly sudden and steep drop in price if something, when they really do hit, a real speed bump. Tonight was not a speed bump at all. I think the analysts were all looking for a speed bump. It didn't happen. So the buying opportunities are towards the top here. The potential selling candidates are always towards the bottom. And in this case, we would direct our attention to Hibbett Sporting Goods, great company, but with a negative projected return based on the current situation. So that's one we're going to challenge or audit here tonight. Here's Hibbett Sporting Goods. They are in the sporting goods retail business. Excellent company. They've been doing very well for the last several years. This is a look at the business model. We've thrown in a couple of things here to make it clearer. The gray shaded area is the recession, the Great Recession that basically kicked a lot of companies in the side a few years ago. We do use analyst estimates in the formation of our trends for 2012, 2013, years ending at those days. So these are analyst estimates up here for 2012 and 2013. We put together this analysis so we can understand the top line, and most importantly the top line growth, which we see checks in at about 9%. So this is a 9% slope up here, and every indication from the company suggests that that is achievable going forward. And they actually didn't suffer that badly during the recession, but you do see a little bit of a trough here. So the other thing that we recommend to long-term investors, if you're looking for a good second opinion when you do your stock studies, like we said on the previous slide, we show a negative 0.4% for the projected return for Hibbett. Value Line actually shows a 3 to 5 year forecast of -2, and we recommend that the long-term investors that are doing stock studies, when you get to the bottom line of your stock selection guide, your number probably should, in at least probably 90 to 95% of the time, align pretty favorably with this number here. It's a good checkpoint. So again, we were at -0.4, they're at -2, and they're certainly in the same neighborhood. Here's a look at the profitability of Hibbett. Again, you see the real impact of the Great Recession, and that was they had to probably do some price cutting to keep the doors open a little bit. And you saw that the margins actually went from levels up here in the 7% range down to the 5% range. Now, they have recovered here over the last couple of years. Analyst estimates for 2012 and 2013 are even more robust. Probably not going to go a whole lot higher than that, but Hibbett clearly is running a pretty good operation here. The third milestone that we pay a lot of attention to is the projected average PE ratio. In this case, Value Line has a 3 to 5 year forecast of 20. And again, straight from Manifest Investing, this is the preferred procedure or the expected income statement summary for the company. We see a company growing at roughly 7.8. Why is that different? Well, apparently Morningstar and S&P and the analyst consensus estimates are a little bit more subdued. And including the 3 to 5 year forecast for Hibbett, it's just a little bit lower than what you saw on the visual analysis, but call it 8%. A net profit margin in the 7% range, that's pretty consistent with what we see here. Again, probably not maintaining this forever, but coming in somewhere in this range over the long term. So not unreasonable to expect a 7% net profit. The PE ratio, we drop down here, we see a 20. Again, that's consistent with Value Line's expectations. And again, that's what produces that negative 0.4. They don't pay a dividend. So that's where the negative comes in for Hibbett. It becomes a candidate for selling and replacing it with something with a more robust return. Second one, we might kick around just a little bit here, and we can do a quick demonstration. Advanced Auto Parts, great story. I mean, depending on when Mad Loop picked it up, probably somewhere back in this time frame. Performance has been quite strong here over the last couple of years, and you can see that here apparently the Value Line opinion, that better second opinion, is a little bit stronger. Keep in mind that that is at a stock price of 75. I believe it's at closer to 90, 88 or 90 today, so that knocks this 8 down a little bit. And we can actually demonstrate, we'll jump off the PowerPoint here in a minute and demonstrate how to do an audit on the equity analysis guide at Manifest Investing. You can actually toss in the assumptions, and you can see the milestone assumptions of 7% sales growth, 6% margin, actually dropping it down a little bit from what it's been, and a PE ratio of 15, just to give an audit of the 6.7. We can actually demonstrate that. So let me go ahead and jump out of the PowerPoint to jump out to Manifest, and we'll take a quick look at a quick study or an audit on a company like Advanced Auto Parts. I'm going to go ahead and jump in here. And if you jumped in just cold off the street, this is what you would see. And basically, we're just importing numbers from the internet. If you've ever wondered what happens with a quarterly update, let's say they come in with their first quarter estimates. This is literally what we do on a continuous basis at Manifest. Come in and enter the new figure for trailing 12 months on the company. You can see we got a little bit of a bump up here. And let's just go ahead and crank in a couple of numbers here just to demonstrate it. Let's assume 7% sales growth. Let's go ahead and assume that net margins can improve going forward from 5 to 6. Just entering 6 and hitting enter. You can see that any number that's affected highlights, and then we're all the way up to 5.3. Let's go ahead and click in and change that PE to 15. And you basically see how we get to the 6.7. This is a great place to play what if. If you take a look at the story that you've built for Advanced Auto Parts, and you decide that it probably makes more sense to think about a net margin closer to 5, you can play sensitivity or what if games. Put in 5 instead. And again, if it's a 5% long-term forecast for the profitability of the company, you can see it drops it down to 2.9. So it's pretty easy to get down into those low single digits, as we were suggesting there with on the dashboard. So that's usage of the My Studies. You can actually save them. And notice that what you literally have here is a side-by-side comparison of what the analysts' expectations are versus what you may have overridden for your own audit, if you want to think of it that way. What I thought we might take a look at now is take a look at the dashboard for for Mad Loot. Okay, go ahead and pull up the dashboard. They should be as of tonight's closing prices. What I'd like to demonstrate now is just kind of a little what-if exercise with the worksheet. We affectionately refer to this as our sandbox. We copy it to a worksheet so that we can play what-if games on the Mad Loot portfolio. Again, you can do all the same functions for anything, sort by the projected annual return from highest to lowest. And you can also take a look at some charts down here below. You can see that there's a fairly significant concentration in technology because of the Google and Apple stakes, but a pretty good distribution outside of the technology sector. The two companies we were just talking about, Advanced Auto Parts and Hibbett, would actually hail from this discretionary part. So we're actually talking about a couple companies within that orange slice there. We also do keep track of not just how much is the overall average, that 11.5% for the overall portfolio, but we do like to make sure that they are split up pretty much, 33, 33, 33, or something along those lines, making sure that you have some medium, some small, and some large companies in the portfolio. So with that, any comments from the audience? Lori or Stu, do you have any comments at this point?
No, I would say I agree with what you've pointed out. We're kind of watching Hibbett's closely, and even without this display that you've provided for us here tonight, we have noticed, obviously, that Hibbett's the price is really moving on us, and we just know fundamentally when the share price gets way ahead of earnings, you are eventually going to run into a problem. So that was definitely on our sell list. AAP, we were, and as you showed us as well, we were also watching, but not as worried about it as we are with Hibbett's, as their earnings seem to be growing just a little better with the share price. So it's kind of funny that you pointed out essentially the same thing that we knew, and we appreciate that that consensus opinion.
Sure, good instincts.
Stuart, yeah, Jean Teakin is asking about AFSI. Do you have a low financial quality rating on that, Mark? I guess she was curious about your interest in that company.
I wish I knew. That came from a member brought it up to us. Just was, I think he found it on that Longfellow's report. I don't know if you're familiar with that. That's,
oh, yeah.
Yeah, that's where that one actually came from. It's very recent. Essentially, like I said, we keep it pretty simple. Member did the SSG. It looked pretty good. We looked at some of the competitors, and it looked like it looked pretty good. So that's why we jumped in it. The only thing that's annoying is this is one of those ones with a limited value line coverage. So those are always a little tougher to do research around. So we usually dig in a little deeper into the conference call transcripts and the financial pages, and it still looked good. So that's really all I can tell you about why we purchased it.
Right, and I'm actually showing the extended value line page now. They're apparently in multi-line insurance, so workman's compensation, commercial insurance, employment liability, farm and ranch. They are out of New York. Small commercial stuff. So it's basically a property and casualty kind of services company on that side. And again, quite an impressive stock price situation. We do get a major indicator over here with the financial strength of B+. Now that is average, but not bad. It's not a bad financial strength rating. What I thought we might do now, Stuart, is just kind of demonstrate the what-if capability of the sandbox, or the worksheet as we call it. If we actually put Hibbett and say, what if we took that money, we put Hibbett down here in the holding zone, and the money from Hibbett has been converted to proceeds from sales, so it's in the cash. Thought we might just go do some quick shopping for things that might fit the portfolio. And so what I'm going to do is jump up here. Let me just go ahead and open, going to go into another manifest folder here. Keep the dashboard is still back over here, the worksheet. Going to go into stock search. And I think what we'll do, since the portfolio does have 49% in technology, you just go ahead and make the bold assumption that maybe you shouldn't shop so much in technology. Tonight, anyhow.
I would agree.
And rather than, well, let's go ahead and use the sweet spot. Let's look for a stock between a 13 and an 18% projected return, because you don't really need much of a boost. We'll put in excellent quality at 65, financial strength of A or above. Let's just make sure we get a company with some growth characteristics to it. Financial or an EPS stability rating of 75. Let's see what that gives us, just for companies that we might consider for the portfolio. And we get a pretty nice list. You already own Portfolio Recovery, or you at least are familiar with it with the other club. Some fairly interesting companies from top to bottom there. Might want to go back and knock it down just for kicks.
We used to own Knight.
Mm-hmm.
Yep.
I'm going to go ahead and...
I noticed in that list we had...
Hold on, go back to the list and let you comment on it. Go ahead.
I was just going to say we currently have GPN, or did we just sell it? It's
still there now.
You happen, oh, okay, yeah, that's one that we have and are also watching closely, and because they just had a problem with the security of their data,
right?
And that took a recent hit. And then Night Transportation is one that we had for a while, but didn't do terribly well with. We had it slightly before the Great Recession and sold it at about the time of the Great Recession.
So there are some interesting companies there. Could look at ResMed, for example. We have recently featured Landauer. Massimo is an interesting medical company. There's just some interesting companies there. I like to lean on the Motley Fools a little bit, and the community of stock pickers there. Put in a Capstar rating of 4, just to kind of filter out the companies that are not in favor these days. See if that knocks the list down. Well, that knocks it down to 11. And just for kicks, let's go back and just say which ones does that successful stock picking community really like? See what we get. Okay, now we're down to 5 or 6, and might be interested in doing some fairly detailed studies on any of those. AeroVironment is a company that is involved in the manufacture of drones for the military and a couple other things. And it is one of the more popular stocks in this year's stock picking contest, known as the Groundhog over here. So several investors have seen some interesting things there. Stantec is a company would be very similar to the one just purchased by Nationwide last night, which we'll be talking about here in a minute. But some interesting.
You know, I'd actually be interested in that AeroVironment. We had a aerospace defense contractor recently, and we sold it probably about a year ago. I forgot which one it was, but that would be an area that we probably would be interested in getting back into. So, yep, I appreciate this this strategy you're showing us.
Okay, so
interesting screen.
What we can do is come back to the worksheet, throw AeroVironment on the board, and we could literally just for a what if, say, well, what if we threw 40 shares at it? Basically about $1,000, bringing it to a 4% position, still got a little bit in cash. But again, notice that we've made a subtle improvement to the projected return of the overall portfolio, because again, we're replacing AeroVironment, a 16-17% return forecast is basically taking the place of a minus 0.4, so the overall average has been improved. So just something to think about there. And again, those are some pretty good companies. I mean, the portfolio is just flat out cool. As I look at this from top to bottom, I mean, Accenture, Novo Nordisk, for those of you that are not familiar with it, excellent study. It's probably not in the buy zone right now, but if you have any thoughts about diabetes and the innovative delivery of solutions in that environment, these guys are top notch. And that's a great core long-time holding. From top to bottom, even Advanced Auto Parts, top-notch stuff. So again, just love the portfolio basically from top to bottom, and you've got the old tried and true fact set research in there too.
Well, I appreciate. Yep, I appreciate your kind words. I think one thing that we tried to get away from when we were, about 3-4 years into the club is we noticed that our club looked like just about every other club out there. There seems to be these core holdings. I'd say 5 years ago it was J&J and Procter & Gamble and Aflac, and today it's Apple. But we tried to get away from those tried and true names that seem to be in every investment club, where when someone would come up with something, we would see if it was in the top 10 holdings of all clubs or holdings on Viveo, and it seemed to really benefit us to go in that direction. Well, so we looked for unique stocks that had passing SSGs in clubs that other people didn't know about.
Yeah, and that actually gives me a chance to get a little bit on the soapbox. When you see the lists of companies that are held by investment clubs, like the Better Investing Top 100 or the Viveo Index of the most widely held stocks by Viveo members, keep in mind that's absolutely not a reflection of what condition they might be in today. And in fact, as you've just described, Stuart, some of those long-term community favorites have been pretty stagnant for 10 years. And in fact, many people around us, and we witness this all the time now, are, they get tired of waiting for an Abbott Labs to come out of the mud, and we see them actually starting to dump some of these companies. And actually, after 10 years of going nowhere, some of them are actually starting to get attractive to the point of they're more attractive accumulation targets than they have been for any time in the last 10 years. So you were probably, you were prudent to avoid many of those community favorites when it just simply was not time to go after them. So that's, again, hats off. Good stuff.
Yep. Thanks.
Okay, in the presentation in the PowerPoint, I just kind of froze a copy of those results. You'll see over here that the criteria for the screening is shared. You'll notice that technology is missing from the bottom half of the screen there. So we left out the technology sector as we were doing shopping, as probably a prudent thing with almost 50% of the portfolio in technology.
Mark, before you go on, just one quick question. Jean Teakin was asking that what broker the club uses, because, and she was wondering if you do dividend reinvestment because you have partial shares.
Okay, go ahead, Stuart.
Yeah, what we use is my stock fund, and we do all window trades, and they offer it once per week, and I think it's on Wednesday at noon or Thursday at noon that it triggers, and it's really cheap if you go that route, but it doesn't order a huge amount of flexibility, and when you sell, it's hard to sell those partial shares unless you sell the complete position. So if you do like a partial withdrawal for a withdrawing, or I would say a member who wants to make a partial withdrawal, it gets a little tricky, and we kind of have to solve that problem, because what you don't see here is I removed these drips and drabs of various holdings that we had over the years that are actually still in the portfolio, but there's probably 6 or 7 stocks that total up to about $100. And at some point, we got to figure out what to do with all of them, because they just get in the way.
Is that something that my stock fund would work with you on, or?
Probably. I mean, worst case scenario, we'll hold on to it till and some of them have done really well. We haven't owned Home Depot, except for that fractional share left over, for about 4 or 5 years. But the lesson there is, it's a nice dividend payer, and the position has actually grown nicely since then. Not the stock price so much, but the impact of the dividends over that time period is pretty funny to watch. I think we've made it to a share now.
Patience over the long term. Fantastic.
Yeah.
All right. Any other questions from the audience before we move on, Laurie?
No.
Everybody's good? Okay, we've got a couple of minutes here we can actually talk about. And this is what I kind of wanted to share with the audience a little bit. Became aware that Stuart is also involved in the Nationwide Investment Club. And this is an online club that has members anywhere from New Jersey to Seattle to Iowa. I know Mark Ekman is in the club. A number of people are. And I just thought, Stuart, if you wouldn't mind just sharing a little bit about how you came upon that, what the experience has been. This is another club with pretty solid return results over that period of time, comparing a little more closely to the Wilshire 5000. But how did you come upon it, and what do you see as an advantage, or what experience can you share there, Stuart?
Well, the club is unique. I think the struggle early on, and it still remains, is meeting with online tools and what kind of an impact that has on how well the meetings go. We probably spend way too much time dealing with snafus regarding internet technology, and that's been kind of tricky to overcome, but I think we're getting there.
That's all getting better. And the technology itself is getting better and cheaper, and I think all that's a benefit. I think the other thing that's kind of tricky to overcome, and I've spoken with other people, not investment club members, about how a club works when you don't know the other members. How do you trust each other? And that is a tricky thing, but it's funny. You spend a year or two with meetings twice a month, and all of a sudden these people who you still haven't met, they become friends, and that trust develops even though you've never met them. So either the club is made up of a whole bunch of excellent sociopaths that are going to rob me blind one day, or they're really a great bunch of people. And if I was to compare the membership of the two clubs, the Nationwide Club is much more skilled, much more experienced, and it offers a different perspective. It's also nice because in my other club I do a lot of the work there. At least from an organization standpoint, but the research comes from everyone. And with this club, I've actually wish I could put more time into Nationwide. Right, I've been slacking a little bit as of late, but it's nice to have other people to rely upon, more I should say. Yeah, and again, it's just an expansion of getting ideas from other places. And I may be a poor judge of character. I don't think I am, but I would trust Mark Ekman like a brother, so I don't think you got anything to worry about there. And I also know a few of the other members. In fact, they're here tonight. That I'd be proud to have them in my club too. Here's a quick look at again. This is a very strong portfolio from top to bottom. I know that with the experience that these guys bring to the table, they're going to do some pretty cool stuff. They also have a very large concentration in Apple. That seems to be going around these days. But pretty broad diversification in terms of a variety of different things. One a little bit creative. I'd love to hear from somebody in the club about Volterra Semiconductor. It's a little bit different situation there, but from top to bottom, again, very typical. And the club actually said that you weren't able to join them last night. They did sell part of their position in Catalyst Health and purchased ACOM Technology, which would be a company very much like Stantec that came up on that list a few minutes ago. I thought we might take a closer look at that. But if any one of them would like to chime in with something, that's fine too. I know there's a few of them here. I thought what we might do is jump out and go back to, again, you could save the changes we made for Mad Loot if you wanted to, or you could save it as a new dashboard for a proposal for a club meeting, if that made sense. But now I think what we'll do is jump out and go to Nationwide. And again, just to demonstrate the fact that you can copy it to a worksheet. And in the case of what they did last night, they sold off a few shares of CHSI, which, by the way, is being taken out by another company at an acquisition premium. This is a company that Mark Ekman brought to my attention quite some time ago. In his professional day job, he does get involved in the analysis of benefit packages, and this is a pharmacy benefits manager, so he had some awareness of them and some others, along with CVS Caremark and a few others. It was kind of fascinating to hear his perspective on that. And they actually added a few shares of ACOM, which is ticker symbol ACM. It's a good study. You'll see that the numbers here are going to compare pretty favorably. They're a little bit friskier than Stantec. And in this case, we'll just go ahead and throw 40 shares at it just to get it into the portfolio. And you'll notice that the overall portfolio quite solid at 13.9, and that move actually made some improvement. Catalyst is down. Let's go ahead and sort these by par. Catalyst is down in return forecast because of the buyout offer that has taken the stock price up fairly dramatically. In fact, let's go over and take a look at the most recent value line report, and I think we'll be able to see. I haven't looked at this, but I'm pretty sure that this, oh, too many files open. There you go. Proof that I've been working for you guys. And now let's go ahead and put in CHSI just to show that it's been a fairly dramatic uptick here. You can see that it was recently down around 50, and as the dashboard showed, it is now at 87. That's a pretty nice reward for recognizing a pretty good company. So again, just to get a look at another club, and again, I would, what Stuart's experiencing here, and seeing the ideas from all around the country and working with this other club, I would contend is also alive and well in these model clubs that have sprung up throughout the country. Chances are there is a model club in your region. If you write to me, I'd be happy to let you know if I know about one, or reach out to your local chapter. They're out there, and they can be, even if you don't join, a lot of these allow you just to observe and witness and extract ideas and that sort of thing. See, it might be a little bit light on the slower, larger companies, slower growing, but not bad. Pretty well spread out, with a very well spread out, and good diversification. So again, another club that's doing fairly well, fairly young. And when it comes to the challenges of the internet, Stuart, I've been there, I've done that. Been doing this, trying to do this sort of thing for the last 10 or 15 years, and until we stumbled on the GoToWebinar stuff, we actually had 4 or 5 different venues, which used to frustrate the heck out of us to varying degrees. And it's been pretty reliable here over the last year or so.
Good.
2 years, almost 3 years now.
Well, we're fortunate that one of our members, through their employer, allows us to use a site similar to GoToMeeting. I think it's WebEx. And what a difference that has made, because we actually used to use GoToMeeting, but you know, the WebEx just seems to work just a little more smoothly for us.
Oh yeah,
and, great
that's
that we
an
have
excellent
it
solution
free.
too.
Certainly, if we were paying for it, it would be a whole other story.
Sure.
Yeah. Free is always good.
Works good. All right, Lori, is there any other questions, or does any of the 2 clubs have any comments? We can certainly dig into
somebody's questioning the holding of Dolby Labs. If you have anything to say about Dolby, they said it doesn't look like to them like it's good on an SSG.
And, you know, I would love to speak to Dolby. I haven't been a fan. I'm an outspoken anti-Dolbyist within the Nationwide Club.
Oh, there's got to be one.
Yeah, and that's fair, you know. That's the way it is. It's a club, and we all put in our 2 cents, and if they put in 98 and I put in 2, we still hold the stock. But nice to find some consensus with my minor opinion.
Yeah,
I agree with you.
It's actually had a little bit of a disruption, and I'm being polite to Dolby. They actually had a pretty good disruption where they lost a fairly major contract last year, and that's why you see this dip down here. They really
that was Windows.
It was a Windows contract that they lost?
Windows 7, yeah. Windows announced in Windows 7 that they're not going to carry, I guess, whatever Dolby technology was in the earlier version of Windows, and that really hurt them a bit. But I really am not the stock watcher for this one, and I know there are some other Nationwide members on the call, so if they'd love to join in.
Yeah, if they want to chime in, we'd love to hear it also. Yeah, but, you know, again, like we mentioned, you know, a fairly decent single opinion out there is always available from Value Line. And what I'm seeing here, let me bump up the text size here a little bit for us. Again, what I'm seeing here is you know, again, nothing that would set the world on fire, but a 10% low total return forecast. That's not exactly the end of the world. I know we were much higher on the company before they lost that Windows contract that Stu just shared. What I would basically do with this company is probably pay a whole lot more attention now to what's going on 2012 and 2013. Let's go ahead and demonstrate how you might do that. I would literally go out and very carefully double check, you know, what the expectations are for Dolby, because this is actually going to factor in the analyst's professional opinion on the outlook for the company for the year ending September 30th, 2012, and then year ending 2013. And this is some of the angst that I think you can actually get into. 942 and 946, if we force that into our guide, into our analysis, by going into the annual data, I think you'll see the impact here begin to take shape. We're basically talking about a situation where this is what the professionals believe could happen with the company. I was just focusing on the sales now. And basically what you see here is, unless they come up with something, this is a bit of a wounded animal. Now, I have a lot of faith in the quality of the company and the management of the company, but they clearly have some work to do here. We're talking about a company that is probably now, unless they capture something interesting, as I said before, a little wounded. I always, I wish I could get the software to keep it that way, always start from the trend line, always. Again, that's not the prettiest picture in the world, and even though I have a lot of faith in what's going on there. And, you know, perhaps they'll be able to rationalize and keep the earnings okay, but the company is struggling a little bit. Again, it's one that we have covered fairly closely. If you go to Manifest Investing and actually click through on Dolby, just to demonstrate something else that some of you may not know about, We have our own little embedded Seeking Alpha, only it's just you guys and the stuff that we kick around. You go into any company, click on the little hourglass when it comes up. You can see that that 10% that we saw in value line is pretty consistent with the 8 or 9% here. And you can actually see that we picked the company for a feature article back in March 2011, and that was before they lost the Windows contract. So you can actually go back and see what the company looked like at that time and just do an assessment of, well, what has changed here? And you can
there's
actually see some people down here.
Yeah, there's also a couple comments that if you look at their per A graph and their next 2 quarters projections, they don't look very good either. So kind of short-term results, I guess, aren't looking too good for them.
Yeah, I never look at PERT, but okay. Any other questions from the audience? Just for kicks, I think I'll throw up, I'll look at Dolby from the technical side. And it's looking pretty weak.
Uh-oh, Mark, now you say you didn't look at PERT. Yeah, you're going to have to explain yourself.
Well, we don't have time to do that tonight. The nutshell version is everything on PERT is rearview mirror. And that doesn't mean I don't look at the rearview mirror, but I think it's important to pay more attention to the windshield and the forward-looking estimates and all that kind of stuff. And there's absolutely nothing on the PERT form, nothing on the PERT form that isn't in this picture right here. And you don't have to go any further than that. So I'm not a big fan of the derivative tools and complexity. Simplicity works for me. So you just got the nutshell. There's nothing on that form that does anything in a superior way or predictive way that this doesn't do. So that's the nutshell answer. Any other comments or questions?
Oh.
I would say, looking at your windshield rear view mirror, I think one's opinion of analysts and the jobs they do and the trust and faith people have in them, I think if you have less faith in the analysts, it's hard to look through that windshield when I think you weigh a little bit more, what's in the rear view mirror. But I agree somewhat with what you're saying as well. You can't only look through the rear view mirror. You do have to dig and kind of make your assumptions and guesses. But I still think a lot of that is based on what you've seen in the past, especially when it comes to evaluating management.
Yeah, and the point that we make with audiences, Stu, is that it doesn't matter whether the analysts are right or wrong. They're a powerful influence, and
that's true.
And there are all kinds of studies out there, the academic studies of how wrong they are, which are probably flawed in themselves. But it doesn't matter how wrong they are. What they think actually moves our stock prices. So in the case of, if you basically pulled up the analyst expectations for Hibbett in this case, and the analyst expectations for earnings were down here, just to make a point. If we pulled up the analyst expectations for Hibbett, and they were down here instead of where they're at, let's say that the E's were down here. Right. If we believe as a community of investors that stock price follows earnings, now keep in mind, we don't know whether this is going to be right or not. This is what they think. They no longer think this. We know that the stock price is going to follow those E's, whether the analysts are right or wrong. And that's why we think that it's extremely important to pay attention to, as we call it, the windshield.
Yep. Now, let me ask you this. Do you do any judgment, not to open up a debate here, but do you look at particular equities where the analysts were way wrong and the stock price does go up because the earnings went way up, regardless of the analysts ripping it apart?
Well, we certainly have an opportunity to do that on a slightly different slant with Apple right now.
Yep.
On an individual basis, absolutely. It kind of falls into the same category of sometimes you can actually find a situation where they're all just not getting it, and then you can find a fairly special, inefficient market situation that you can take advantage of. Now, I would say they're rare. I mean, I probably only see like one or two of them at the most a year, and I do hundreds of guides, thousands of guides.
Yeah, yeah.
So I think that condition is actually fairly rare. And but again, it really is what they think and what they're projecting is a much bigger influence, right or wrong.
I hear you.
Interesting debate for another time, but we are running up against the clock here a little bit. We are at an hour. Any other comments that you might want to bring to this, Stu?
No, just I'd like to say thank you. It's very interesting. My club isn't very manifest investing savvy, but we may want to become. This is a pretty interesting way of doing it.
Well, interesting. We're very grateful to you for offering yourselves up to be kicked around a little bit. And again, kudos. Keep going. I would love to see you guys grow and get more members involved just for their benefit, because I think people who come and discover the opportunities there are going to do better. But again, thanks for please give our best regards to all of your club partners, and the same goes for all of you nationwide folks out there. And we appreciate you being there. So with that, I think we'll say, Lori, you have any other housekeeping you need to do?
Well, somebody was asking, because you had mentioned that you always project from the trend line, why that was.
Because that's what Nicholson used to do. All the time. Again, that's a subject for a much greater detail. I'll just leave you with one very enticing fact. And the fact is, in the old days, back in the good old days, before the quarterly box existed on the Stock Selection Guide, many of the gurus I used to hang out with, they never filled in the quarterly box. So they literally paid very little attention to quarterly stuff. I mean, think about the impact of that statement. I mean, that's just simply the way it was. It's a fact. Did want to point out that we have a couple of things coming up as we go ahead and sign off here tonight. Let me get this out of the way, get up here, and we'll just leave it with making you guys aware that there are a couple things going on. I probably will put on a couple of webcasts this coming Saturday morning. Those should appear tomorrow. But next Monday night, we have our monthly roundtable session where I'll be joined by Ken Kavula, Cy Lynch, and Hugh McManus as we continue to try to take care of that roundtable model portfolio and share our best ideas come next Monday night. So you're all certainly welcome to join us for that. And with that, we hope that all of you have enjoyed this tonight. And again, use the event screen at Manifest to stay aware of other opportunities, and let us know how we can present other stuff. Tell us what's on your mind. Ask us for what you want, and we'll try to deliver that. So with that, we'll just say thanks for coming tonight, and take care, everybody. Good night.